imagine a company that just saw its future sales pipeline basically fall off a cliff.
Right.
We're talking about a 26% drop in net new bookings in a single year.
Which is massive.
It's massive. And if you're a retail investor or, frankly, anyone watching the stock market, that is usually the exact kind of metric that causes Wall Street algorithms to just
completely hit the panic button.
Exactly. They hit the panic button and they dump the stock. You'd think the whole business is imploding.
Oh, for sure.
But then you look at the very next line on their earnings report, and that exact same company just posted an 817% spike in net income.
Yeah, it's an absolute financial paradox.
It really is.
And it's exactly the kind of contradiction that makes earnings season so treacherous, if you're only reading the automated headlines.
Right.
Because you can't just cost cut your way to infinity. So when you see a pipeline shrinking while profits just explode like that, you really have to dig into the actual mechanics of what the business is doing.
Which is exactly our mission for you today. Welcome to the Special Talk Tickers edition of the Deep Dive, where we are taking the latest Q2 2026 earnings call from CoStar Group.
Ticker symbol CSGP.
Ticker CSGP, yes. And we are completely throwing out the PR spin, getting granular with the data today. So for some quick context, CoStar is an absolute giant in real estate data and marketplaces. They own platforms that you've definitely heard of, like apartments.com and homes.com.
Right, huge consumer presence.
But this quarter's earnings call, it wasn't just a standard financial update. It was basically a masterclass in restructuring.
Oh, absolutely.
So today we're going to strip away all the dense corporate jargon, and we're going to figure out how a digital business actually operates in a really stressed real estate market.
Because it is very stressed right now.
It is. And ultimately, we want to give you a bottom line verdict on whether this paradox is a bullish opportunity or a bearish warning sign for your portfolio.
Right, because the story here, it isn't just about selling software anymore.
Yeah.
It's about, how you optimize a sales force, how you weaponize artificial intelligence to literally shrink your operating costs.
Yeah.
And this is the big one, how you choose to defend your pricing when your biggest competitors are just desperate and slashing theirs.
Oh, yeah. The pricing war is wild. So let's just start with the hard data. The Q2 top line and bottom line figures are fascinating, mostly because they just shouldn't exist in the same reality.
They really shouldn't.
I'm going to lay out the numbers for you. First off, Q2 revenue came in at $925 million.
Okay.
That is an 18% year-over-year increase. And management made a very, very specific point to highlight that this marks their 61st consecutive quarter of double-digit revenue growth.
Which is insane.
I want to pause right there, actually, because that number feels made up. 61 quarters.
If you do the math, it stands over 15 years.
Over 15 years of double-digit revenue growth every single quarter. That means they maintain that streak through the 2008 housing crash, through the pandemic freeze in 2020, and through the brutal interest rate hikes we've seen over the last couple of years.
Right.
How is that even mechanically possible in real estate? Because arguably it's the most cyclical boom and bust industry on the planet.
It is, but they do it by not actually being a traditional real estate company. Right?
Okay, what do you mean?
Well, they don't swing hammers, and they don't hold speculative property portfolios. They are fundamentally a data and marketplace monopoly.
Got it.
So think about it. When the real estate market is booming, developers and brokers buy CoStar data to find new opportunities.
Sure.
But when the market is crashing, those exact same brokers buy CoStar data to figure out, who is distressed and where they can salvage capital.
Oh, wow. So they win either way.
Exactly. The 18% revenue growth this quarter, hitting that $925 million, it just proves that their subscription model is incredibly sticky, totally, regardless of what the Federal Reserve is doing with interest rates.
Right. Okay. So the revenue engine is reliable, but that brings us to the profitability, which is where things kind of go completely off the rails.
Yeah, this is the crazy part.
Okay, let's unpack this. Q2 adjusted EBITDA, which for you listening is earnings before interest, taxes, depreciation, and amortization, came in at $184 million.
Right.
That is more than double what it was a year ago. It pushed them to a 20% margin, which they hit a full quarter ahead of management's own schedule.
A full quarter early.
And then the truly wild metrics. EBITDA rose 441%, and net income was up a staggering 817%. Revenue is up a healthy 18%, but EBITDA is up over 400%, and net income is up over 800%. How exactly did they squeeze that much profit out of this quarter?
So this is where you really have to look under the hood. I mean, they didn't magically sell 800% more product to generate that net income.
Right.
The operational leverage here is the actual story. While they grew that revenue by 18%, their operating costs only increased by a mere 2%.
Wait, hold on. I need to visualize that. They brought in almost $1 billion in quarterly revenue, growing the top line by nearly a fifth, but the cost to operate the entire global company basically just stayed flat.
Essentially, yes.
I mean, a 2% increase in costs is basically just inflation. How do you scale operations without scaling your expenses?
Well, you have to look at the crown jewel of their cost discipline this quarter, which is the residential segment.
Okay.
This is the division that houses homes.com and apartments.com. And historically, this has been a massive cash furnace for them.
Oh, yeah, all those commercials.
Exactly. They were spending hundreds of millions on, Super Bowl ads, huge marketing campaigns, and building out the platforms just to compete with the likes of Zillow and Realtor.com.
Right.
But in Q2, for the first time since the first quarter of 2024, that residential segment actually hit positive adjusted EBITDA.
So they finally crossed the threshold from burning cash to generating cash?
Yes. They brought in $12 million in positive EBITDA on $444 million in revenue for that segment alone. And that revenue is up 33% year over year. So what management really proved to Wall Street this quarter is that they have successfully pushed these massive consumer portals past that incredibly expensive initial user acquisition phase.
I see.
They are now harvesting the profits. They clamp down on the exorbitant marketing spend because the brand awareness is finally there.
But see, that leads me directly back to the paradox I started with.
The bookings.
Yes. If they stop spending so much, and that's why profits are up, we have to talk about the net new bookings, because net new bookings came in at $69 million.
Right.
Yes, that is up 3% from the previous quarter, but year over year, it is down roughly 26%.
Which is a big number.
It's huge.
Yeah.
You can call it operational leverage if you want, but you can't just stop feeding the engine and expect the car to keep winning races, right?
Right.
Net new bookings are the lifeblood of future revenue in a subscription business. If bookings are down 26%, doesn't that mean like 18 months from now, that 61-quarter streak of revenue growth is just gonna die?
Look, it is a totally valid concern. And honestly, it's exactly what an algorithmic trading bot flags when it triggers a massive sell order.
Exactly.
But you have to remember, a booking in this specific context isn't just a random consumer clicking buy on a website.
Okay.
These are active contracts sold by human beings to real estate professionals.
Yeah.
The drop in bookings isn't a sign of shrinking market demand or some failing product. It is the direct mathematical result of a highly calculated, highly aggressive restructuring of their sales force.
Wait, you're saying they intentionally shrank their own pipeline?
They intentionally shrank the headcount generating that pipeline, yes. Yeah. Specifically over at homes.com.
Okay, let's get into that.
Let's look at the mechanics of how they were actually selling. So at the end of the fourth quarter, CoStar had roughly 660 inside sales reps dedicated to homes.com.
Wow.
And by inside sales, we mean people sitting in a centralized call center in Richmond, Virginia, essentially just dialing for dollars.
Like cold calling real estate agents across the country.
Exactly.
And they took that number from 660 down to about 400 today.
Yeah.
I mean, they eliminated over 250 sales jobs. Why hire 660 people in the first place if you're just going to gut the entire department a few months later?
Because inside sales is incredible for speed to market. When homes.com launched its monetization strategy, they just needed brute force.
Right.
You hire a massive team of recent college grads, you give them a script, and you basically have them call every single real estate agent in America.
The shotgun approach.
Exactly. And it worked initially. They generated over $100 million in organic revenue in the first 2 years using that exact model.
Okay.
But inside sales has a ceiling, especially in the residential real estate market.
Well, let's break down that ceiling. What is the limitation of a call center when you're selling software to a real estate agent?
Think about the psychology of a real estate agent.
Okay.
They are inherently local, hyper-relationship-driven professionals. Their entire livelihood is based on shaking hands, knowing the neighborhood, and building personal trust.
Sure, absolutely.
If you are a high-producing agent in, say, Dallas or Chicago, You are constantly being bombarded by vendors trying to sell you lead generation tools, SEO services, or portal placements.
Right. Everyone wants a piece of their commission.
Exactly. So when you get a cold call from a 23-year-old sitting in a cubicle in Virginia who doesn't even know the difference between your local neighborhoods, your immediate instinct is just to hang up.
It's transactional. You can't build meaningful, high-dollar local trust over a Zoom call or some generic cold email.
Exactly. The low-hanging fruit was gone. The agents who were going to buy based on a quick phone pitch had already bought.
I see.
So to get the high-value agents, the ones who control the real volume in those markets, CoStar realized they had to change their entire approach. So they traded sheer volume for surgical precision. They're pivoting to a field sales model.
Okay, it's like a baseball team trading away a bunch of average rookies to afford a few heavy-hitting veterans. Explain the mechanics of this field sales pivot. How is it fundamentally different?
Well, instead of hundreds of generalists on the phones, they are deploying an initial strike force of 50 highly experienced specialized reps directly into 5 major metropolitan markets.
Which ones?
Washington, D.C., Tampa, Atlanta, Dallas, and Chicago. And they aren't hiring fresh grads for this. They're looking for top producers, people who have actual boots on the ground real estate experience or who have, sold for competing portals in the past.
So they are replacing the call center with expensive, seasoned veterans who actually live in the markets they are selling to.
Yes. A field rep can go to local brokerages, they can attend open houses, take an influential broker to lunch, and actually explain how the Homes.com algorithm specifically benefits their listings in Dallas.
Right.
It's a consultative sale rather than just a transactional pitch.
And I have to be cynical here for a second. I'm looking at the numbers from the call, and management claims that even with this massively reduced sales force, the production per rep increased by 19%.
Right, they did say that.
If you fire a third of your sales staff, isn't production per rep naturally going to go up just because you fired all the low performers?
Yes, exactly.
I mean, it's a statistical illusion, right? The remaining people aren't necessarily working 19% harder or better. The average just shifted because you literally chopped off the bottom of the bell curve.
That is part of it, absolutely. Yeah. If you remove the bottom 250 performers, the average of the remaining 400 will mathematically just be higher.
Right.
But management is arguing that it's actually more than just a math trick.
How so?
By removing the low performers, you stop burning through your total addressable market with bad pitches.
Ah, okay.
Think about it. Every time an inexperienced inside rep makes a clumsy cold call and gets rejected, they potentially poison that lead for a future, much better rep.
That makes total sense.
By trimming the fat, you preserve the relationship capital in the market for your absolute top performers.
Okay, yeah, it's like sending one master negotiator into a hostage situation instead of 10 rookies with megaphones. But let's tie this back to the bookings drop. Because for you listening, if you're an investor looking at that 26% year-over-year decline in net new bookings, how long should you expect this pain to last?
Well, when you take 260 people off the phones, your total volume of new contracts signed in that specific quarter will plummet. That is totally unavoidable.
Right.
But you really have to look at the quality of those contracts. The churn rate, which is the percentage of people who cancel their subscription plummets when you have a field rep managing the relationship.
Because it's a real relationship.
Exactly. An inside sales rep might, pressure an agent into a 6-month trial they don't really want, which they just cancel immediately.
Yeah.
A field rep builds a long-term partnership.
So the gross bookings number goes down, but the actual lifetime value of those bookings goes up.
Yes, and the overall profitability of the division goes up with it. It's accepting short-term top-line pain to secure a permanent long-term bottom-line advantage.
Speaking of long-term advantages, we need to shift gears from Homes.com over to Apartments.com because the dynamic over there sounds like an absolute battlefield right now.
It really is.
If Homes.com is a story of restructuring a sales force, Apartments.com is a story of a brutal pricing war in a deeply stressed market. Set the macro stage for us here. What is actually happening in the multifamily rental space right now?
It's essentially a perfect storm of oversupply meeting really high interest rates.
Okay.
During the pandemic, when interest rates were near zero, developers started building apartment complexes at a historic, unprecedented pace.
Because money was practically free.
Exactly. Money was cheap and rents were skyrocketing. Fast forward to today, and all of those buildings are finally finishing construction and hitting the market simultaneously.
So the pipeline is just opening up all at once.
Exactly. But now, inflation has heavily squeezed the renter, and interest rates are punishing the property developers who took out variable rate loans. Supply is heavily elevated, which means vacancy rates have spiked. Property owners are sitting on empty units, bleeding cash on their monthly debt service. So, to get renters in the door, they are resorting to widespread concessions.
What does a concession look like practically for a renter?
It's the first month free banner you see outside a new complex. Or, sign a 12-month lease, get a free $1,000 gift card, and waive parking fees.
Oh, wow.
Management actually noted on the call that almost 40% of apartment communities are offering significant incentives right now. It is a desperately price-sensitive environment for property managers. Every single dollar they spend on marketing is being scrutinized heavily.
And in the middle of this desperation, you have competitors, and CoStar specifically called out Zillow on the earnings call without even trying to be subtle about it, who are aggressively discounting their advertising packages.
Oh, yeah.
They are trying to buy market share by basically saying to property managers, hey, we know you're hurting, so we'll cut our listing fees by 40%. Yeah. But CoStar's response, they are flat out refusing to play that game. They are holding firm on what management kept referring to as price integrity.
What's fascinating here is that it's an incredibly risky strategy if you really think about it.
That's exactly what I want to challenge. I mean, price integrity sounds like a lovely piece of corporate PR spin.
Yeah.
But let's live in reality for a second.
Sure.
If I'm a property manager with 15 empty units, my boss is screaming at me and I'm staring at 2 advertising proposals. One from Zillow that is heavily discounted and one from CoStar that absolutely refuses to budge on price. Why on earth would I choose CoStar right now?
Right.
Holding the line on price when your competitors are slashing theirs usually just results in you losing all your customers.
It does, usually, unless you have one specific, undeniable advantage. Superior return on investment.
Okay, explain that.
CoStar isn't holding their price out of sheer stubbornness or ego. They are leaning entirely on the mathematical performance of their product.
The conversion rate.
Yes. They cited an independent study on the call by a firm called PRQ that analyzed over 1,000 properties. And the finding was just striking. Apartments.com leads convert to actual signed leases at 2.5 times the rate of their next closest competitor.
Wait, 2.5 times?
Yes.
Let's unpack the mechanics of that. Why would a lead from one website convert 250% better than a lead from another? Aren't they both just people looking for an apartment?
You'd think so, but not all leads are created equal.
Okay.
If a platform prioritizes massive traffic over everything else, they might make it incredibly easy for a user to just click request info on 30 different apartments in 5 minutes.
Right.
That generates 30 leads for the property managers. But those users are just window shopping. They haven't checked the floor plans. They don't know the pet policy. They haven't verified if the commute even works for them.
So the property leasing agent gets an email, spends 20 minutes calling the person, only to find out they have an aggressive dog breed that isn't even allowed anyway.
Exactly. It's a low-intent lead. CoStar's argument is that Apartments.com provides so much granular data upfront, like 3D tours, exact real-time availability, deep neighborhood data, that by the time a user actually clicks contact property, they are highly qualified and ready to sign.
So a cheap lead that doesn't convert is actually the most expensive lead of all because it just burns your leasing staff's time.
Precisely. If you buy the discounted Zillow package, you might get 100 leads, but your staff wastes 40 hours calling them and you sign one single lease.
Yikes.
But if you buy the premium CoStar package, you might only get 20 leads, but you sign 5 leases.
That's a huge difference.
CoStar is betting their entire pricing strategy on the fact that property owners will eventually wake up from the allure of cheap advertising, realize their vacancy rates aren't improving at all, and return to the platform that actually puts heads in beds.
But this isn't just a polite disagreement over advertising conversion rates.
No, not at all.
This rivalry has spilled over into a full-blown legal war. CoStar brought up some massive legal developments on the call that show how vicious this digital real estate battle has actually become. They noted that the FTC, alongside multiple state attorneys general, have sued Zillow for allegedly entering unlawful agreements that reduced competition.
Yeah, the regulatory scrutiny in this space is really intensifying right now because the data is just so valuable.
And CoStar isn't just relying on the government, they are actively suing Zillow themselves.
Right.
They are alleging unauthorized use of tens of thousands of CoStar's copyrighted apartment photographs to basically build out Zillow's rental marketplace.
Yeah.
This feels bigger than just a copyright dispute over some pictures of swimming pools, right? What is the actual strategic implication here?
It is a stark reminder to any investor analyzing tech platforms right now. In digital marketplaces, the ultimate barrier to entry is proprietary data.
Data is the moat.
Exactly.
Yeah.
CoStar spends millions of dollars sending fleets of photographers and researchers physically to apartment buildings to map out floor plans, take high-resolution photos, and verify amenities. That is incredibly capital intensive.
It's real-world, boots-on-the-ground labor.
Right. And a competitor's easiest shortcut is to build an algorithm that just scrapes those images and data off the internet to populate their own site for free.
Right.
By pursuing this lawsuit so aggressively, CoStar is highlighting that you cannot just scrape your way to the top without inviting massive legal and regulatory destruction.
They're playing hardball.
They're weaponizing their legal department to enforce their data moat. They are proving to investors that their competitive advantage isn't just a strong brand name, it is a legally protected proprietary data set that competitors literally cannot replicate without spending billions.
So they are holding the line on price, fighting off cheap competitors with a superior ROI argument, and heavily relying on their data moat. But this brings us to the most fascinating technological revelation of the entire call. Here's where it gets really interesting.
Oh, this part is great.
It feels like every single earnings report right now, from fast food chains to software giants, is legally required to say the words artificial intelligence 50 times.
Oh, it is the ultimate buzzword bingo right now.
It really is. But mostly, when companies talk about AI right now, they're talking about massive capital expenditures.
Right.
They're spending billions on NVIDIA chips, infrastructure, and token costs. But CoStar dropped a data point that goes completely against that trend.
Completely opposite.
They stated they are currently saving more money on labor through their AI tools than they are spending on AI token costs. They're actually coming in completely under budget on AI expenses.
For a tech-focused investor, this might literally be the single most crucial takeaway of the entire quarter.
Okay, let's slow down and explain the mechanisms here, starting with token costs.
Sure.
What exactly does a company mean when they complain about token costs ruining their profit margins?
So think of a token as a unit of computation for an AI model, right?
Yep.
Every time a user interacts with a generative AI, like asking ChatGPT a question, the model has to process that input and generate the text. That requires serious server power. The AI providers charge the software companies fractions of a cent per token.
So if a user types, a 3-sentence prompt, that might cost the company a penny.
Exactly. It sounds trivial. But scale that to a consumer platform like apartments.com with tens of millions of monthly visitors.
Oh boy.
If you give all of them an open-ended AI chatbot to play with, and they start asking it to write, poems about 2-bedroom apartments in Seattle, those fractions of a cent multiply into millions of dollars in compute costs overnight.
Just burning cash on silly prompts.
It can completely obliterate your profit margins. That's why Wall Street is terrified of AI token costs for software businesses right now.
But CoStar found a way to neutralize that cost.
By deploying AI internally as a deflationary operational tool before they deploy it externally as a consumer toy. Specifically, they are using a process called AI lease abstraction.
AI lease abstraction. Okay, let's get granular. What does that actually mean for their bottom line? What is a commercial lease in reality?
Right. So if you rent an apartment, your lease is probably a standard 5-page document.
Yeah. Pay this much on the first of the month. Don't break the walls.
Exactly. But a commercial real estate lease is a totally different beast. When a massive office tower is leased or a retail space in a mall is secured, the lease is a complex, bespoke, 50 to 150-page legal contract. It contains highly specific clauses.
Like what kind of clauses?
Things like tenant improvement allowances, which dictates how much the landlord will actually pay to build out the office. Or escalation clauses that tie rent increases to a specific local consumer price index over 10 years.
Wow.
Or co-tenancy clauses that say a small retail shop can actually break its lease if the massive anchor department store next door goes out of business.
It's essentially a dense financial derivative written in legalese.
Exactly. Now, CoStar's entire business model revolves around data. When a building is sold, or when they are building a massive analytics database like their new CoStar Rent Benchmark, they need to understand exactly what is inside all of those leases across a city to determine the true value of the real estate.
Historically, how did they extract that data?
brute force human labor.
Just reading them.
Yep. You would need an army of human researchers, paralegals, and analysts physically reading through thousands of 50-page documents to manually extract the data points and type them into a spreadsheet.
That sounds awful.
It is incredibly slow, highly prone to human error, and massively expensive.
So they applied AI to this bottleneck.
Yes, they took 4 million actual leases and lease documents and fed them into a proprietary AI engine. The AI acts like the ultimate Control F function. It doesn't just search for keywords. It actually understands the legal context. It can instantly read a 100-page document, identify the co-tenancy clause, calculate the escalation schedule, and convert all of that unstructured legal text into clean, structured, auditable data records in literal seconds.
So the labor savings there aren't just incremental, they are structural. You are eliminating thousands of hours of paralegal work.
The labor savings are astronomical.
What?
And here is where it ties back to the token costs we were talking about.
Right.
Because they are saving so much money on the back-end operations with AI lease abstraction, it creates a massive financial cushion.
I see. So when they roll out the shiny consumer-facing AI features, like the new apartments.com AI search assistant that lets a renter just type, "I want a quiet place near a dog park with a gas stove under $2,000," the compute costs of those natural language searches are being entirely subsidized by the back office labor savings.
Precisely. They aren't treating AI as an expensive marketing feature they just have to buy to stay relevant. They're treating it as an operational efficiency engine that just happens to have a consumer benefit.
And is the consumer benefit actually working?
It is. They noted that users engaging with the AI search on apartments.com are spending 3 times longer on the site, viewing twice as many listings, and crucially, their traffic to lead conversion rate is up 256%.
A 256% increase in conversion because the AI is helping people find exactly what they want faster.
Exactly. It creates a perfectly closed loop. Better search technology leads to higher user engagement. That higher engagement leads to vastly better, more qualified leads for the property managers.
Which justifies the price.
Right. Those high-converting leads justify CoStar's refusal to drop their prices. That pricing integrity allows them to hit that $12 million in residential profitability. And the AI labor savings ensure the margins stay thick. Every single piece connects to the others.
Right. So the operational story is airtight. They are ruthlessly cutting the fat in their sales departments. They are standing their ground on pricing in a brutal market. They are legally defending their proprietary data. And they are using AI to actively shrink their operational expense baseline.
It's impressive.
The company sounds like an absolute fortress. But this intense, singular focus on cost control and margin expansion naturally impacts what management is willing to promise Wall Street for the rest of the year.
Yes, the guidance.
Which brings us to the guidance, or what we should probably call the revenue haircut.
This is the exact moment on the earnings call where the algorithmic traders get tripped up and where retail investors who understand the mechanics can actually find real opportunity.
Right, so let's look at the numbers they provided for the future. Looking ahead to the immediate future, CoStar expects Q3 revenue to be between $935 million and $945 million.
Okay.
That is a solid 13% increase year over year at the midpoint. Nothing wrong there. But here's the kicker. Management revised their full year 2026 revenue guidance downward. The new expected range is $3.715 billion to $3.755 billion.
Yeah, and whenever a company that is fundamentally priced as a growth stock revises its full-year revenue target downward, alarm bells ring violently on trading floors.
The algos go crazy.
The immediate assumption is that the core product is failing, or competitors are stealing market share.
But you can't just stop at the top line number because the rest of the guidance tells a completely different story.
It really does.
While they cut the revenue target, they simultaneously affirmed their full year 2026 EBITDA guidance. They are keeping it at a massive $780 million to $820 million.
Right.
And even more surprisingly, they actually raised their full year earnings per share, or EPS, to a range of $1.32 to $1.39.
Which is why.
Let's translate this. They are explicitly telling the market, we are going to make less total money this year than we thought, but we are going to generate the exact same amount of core profit, and our actual earnings per share will be higher. How do you shrink the pie but increase the slices?
If we connect this to the bigger picture, this guidance is a masterclass in prioritizing the quality of revenue over the sheer quantity of revenue.
Okay.
It is a very mature pivot. The revenue cut isn't because the core data business is failing. It reflects a calculated, deliberate sacrifice across 3 specific areas of the company. They are literally looking at their revenue streams and amputating the limbs that just don't generate high margins.
Let's break down those 3 areas of amputation because this is where the strategy becomes crystal clear for the listener. What is the first area?
The first area is the active restructuring of their 10X business.
Let's explain 10X real quick. What is it and why is it struggling?
So 10X is essentially an online auction platform for commercial real estate.
Yeah.
If you want to sell a shopping mall or an office park quickly, you put it on 10X, buyers bid on it globally, and the transaction happens digitally.
Got it.
It's a great business model when the commercial real estate market is fluid. But right now, the commercial transaction market is heavily depressed.
Because of the rates.
Exactly. Because interest rates are so high, buyers can't get cheap financing, and sellers refuse to lower their asking prices to meet the new reality. So the market is just in a stalemate.
So transaction volumes on 10X are inherently low right now, simply because nobody is buying or selling office buildings.
Exactly. Now, if CoStar were purely obsessed with top-line revenue, they could pump millions of dollars into marketing 10X. They could offer massive fee discounts to sellers just to force some transactions through the platform.
Which would boost revenue.
Right, that would inflate their top-line revenue number to keep Wall Street happy. But it would be incredibly unprofitable revenue.
It's like spending $100 on advertising to sell a $50 product. The revenue goes up, but you're burning cash.
Right, don't push a boulder up a hill. Instead, management chose to restructure 10X to improve its underlying profitability, just accepting that the total transaction volume, and therefore the top-line revenue, will be lower until the macroeconomic environment actually improves.
That makes total sense. That decision naturally lowers the full-year revenue expectation, but protects the EBITDA.
Precisely.
What is the second area driving the revenue haircut?
Oh, we already spent a lot of time on it.
Yeah.
The optimization of the Homes.com sales force.
Right, the 260 reps.
When you fire 260 inside sales reps, you are saving a massive amount of money on payroll, benefits, and office overhead. That massive cost savings is what boosts your EBITDA and allows you to raise your earnings per share.
But you lose the sales they would have made.
Exactly. By removing 260 people from the phones, you are also temporarily foregoing the marginal low-quality revenue those reps might have eventually generated.
You lose the bad sales, but you keep the profit. And the third piece.
The third piece is the pricing strategy at Apartments.com.
Right.
If CoStar panicked and dropped their advertising prices by 30% to match Zillow, they would probably secure a massive influx of property managers signing up. They could easily boost their top-line revenue numbers to hit that original full-year guidance.
But again, it would destroy their profit margins.
Exactly.
Yeah.
So across all 3 of these major divisions, -10X, Homes.com, and Apartments.com-management is looking at low-margin, high-effort revenue and simply saying, no, thank you.
They are vigorously protecting their bottom line.
Yes.
It is a highly disciplined, profit-focused approach that you honestly rarely see in hypergrowth technology companies. Usually, tech CEOs are so terrified of their stock price dropping that they will buy top-line growth at any cost, even if it means destroying their balance sheet.
Oh, we see it all the time.
But CoStar is doing the exact opposite. It's like realizing you don't need to eat 5,000 calories a day to look big if you just focus on eating 2,000 calories of pure protein.
I like that analogy.
The gross weight on the scale might go down, but your actual muscle mass and structural health goes up.
And leading that structural fitness program heading into the next few years is going to be a slightly new cast of characters in the C-suite.
Right.
We need to touch on the executive shuffle because leadership transitions always factor into how you should view future guidance.
Absolutely. CoStar announced on the call that their chief financial officer, Chris Sloan, is departing.
Yep.
He's leaving to take the CFO seat at Allstate. To replace him, they aren't bringing in an outsider. They are promoting a longtime company veteran named Robin Rossman.
Robin Rossman, yes.
Why does this specific promotion matter to the investor listening right now?
It matters because Robin Rossman isn't just a traditional accountant or, a purely financial numbers guy. He is an operational heavyweight.
Okay.
For the past decade, he has been running CoStar Group's actual businesses globally. He knows the mechanics of how the data is collected, how the sales teams operate, and where the operational bloat hides.
And his recent track record seems to perfectly mirror the exact strategy we've been talking about.
Absolutely. The CEO, Andy Florence, specifically noted on the call that over the past 2 years, Rossman was tasked with fixing the margins of their European business.
Which was struggling.
Europe was a very tough market for them. Rossman went in and executed a brutal but necessary optimization. He eliminated approximately $50 million in costs, which represented roughly 25% of their entire European cost structure.
A quarter of the costs.
But crucially, he did it while still delivering double-digit revenue growth in that specific region.
He cut a quarter of the expenses without killing the momentum.
That is the holy grail of corporate management.
Right.
And it is the exact playbook CoStar is now executing on a global scale.
So it's a signal.
By elevating the specific executive who proved he can slash costs while maintaining growth to the CFO role, the CEO is sending a massive, unmistakable signal to the market. He is telling Wall Street, we are laser focused on our long-term 2026 through 2030 EBITDA targets, and I am putting my best operational surgeon in charge of the finances to ensure we actually hit them.
Okay, so we have laid out the entire operational map. We see the paradox of the 800% profit spike against the dropping bookings.
Yep.
We understand the mechanics of the inside-to-field sales pivot. We've debated the risky pricing strategy against Zillow, the legal moats, and the deflationary power of AI lease abstraction.
We covered a lot.
We see why they cut their revenue guidance to protect their earnings per share. Now it is time to put all of this data into a concrete, actionable perspective.
The verdict.
Yes. So what does this all mean? I want your final, unvarnished verdict. Is this earnings call, with all its contradictions, a bullish or a bearish signal for the retail investor?
If you are a long-term investor willing to hold this stock for the next 3 to 5 years, I am taking a strong bullish stance. Without hesitation.
Okay, defend that position. Because a lot of people will look at a downward revenue revision in a growth tech stock and immediately run for the exits. Why should the retail investor ignore that instinct?
It fundamentally comes down to understanding the difference between short-term market mechanics and long-term business fundamentals. As we discussed, Wall Street algorithms and institutional momentum traders are literally programmed to trigger sell-offs, the millisecond. A downward revenue revision hits the wire.
It's automatic.
It is an automated reflex. But retail investors, the people listening to this who actually take the time to understand the mechanisms of business, have a luxury of looking past the next 3 months. They can examine the actual cash-generating engine of the company.
And you believe that engine is structurally sound?
I believe it's roaring. CoStar is proving, with hard data, that they possess 2 of the most valuable traits a company can possibly have in a volatile high-interest rate environment.
Which are?
First, they have absolute pricing power. Their refusal to discount apartments.com, even when competitors are offering fire sale rates, proves they know their ROI is superior. They are forcing the market to bend to their value proposition rather than racing to the bottom.
And the second trait?
Unbelievable operational leverage. When a company can grow its top-line revenue by 18% while only increasing its operating costs by 2%, they have built an infinitely scalable machine.
It is crazy.
Hitting a 20% EBITDA margin a full quarter ahead of schedule and generating $184 million in pure profit isn't a fluke. It's the result of systemic efficiency. The fact that they are cutting their top-line guidance is actually a symptom of their immense strength. They are financially secure enough to just walk away from bad, unprofitable revenue.
So let's make this highly actionable for the listener right now. Let's split the audience into 2 camps.
Okay.
If someone is currently holding the stock, what should they be thinking as they watch these numbers roll out?
If you are already holding CSGP, you should feel incredibly comforted by how management is treating your capital.
Why?
They aren't just sitting on this massive pile of cash they are generating, and they aren't wasting it on foolish, overpriced acquisitions either. In the first half of 2026 alone, they've already spent $587 million repurchasing their own shares.
Let's explain the mechanics of a share repurchase for a moment, because it's often misunderstood as just some stock price manipulation tactic. How does a buyback actually help the investor who is holding the stock?
Right, so imagine a company is a pizza cut into 100 slices. If you own 1 slice, you own 1% of the company's profits.
Simple enough.
If the company uses its cash to buy back 20 slices from the market and basically destroys them, there are now only 80 slices left in total.
Right.
Your 1 slice suddenly represents a larger percentage of the entire company, meaning you are entitled to a larger share of the profits without you having to spend a single extra dime.
It artificially boosts the earnings power of every remaining share.
Exactly. And CoStar has been aggressive with this. Since the beginning of 2025, they've repurchased nearly 21 million shares for about $1.2 billion.
Wow.
That is a massive deployment of capital. It shows that management firmly believes their own stock is deeply undervalued. They believe the best investment they can make right now is basically just betting on themselves.
Okay, that's the holders. What about the second camp? If an investor is sitting on the sidelines watching this digital real estate war unfold, and they are considering buying into the stock, what is their actionable takeaway?
You need to watch the market's reaction to this specific earnings call like a hawk.
Why?
Because of that top-line revenue haircut, it is highly likely that algorithmic selling will cause a short-term dip in the stock price. The algorithms will punish the shrinking gross revenue, completely ignoring the 817% increase in net income and the AI labor savings.
So the market's blind spot becomes the entry window.
Precisely. It is the classic Warren Buffett mentality, be greedy when others are fearful.
Right.
If the broader market is fearful of a strategic, calculated restructuring that actually raises earnings per share and expands profit margins, that is your window. You would be buying into a fundamentally sound, highly profitable, AI-optimized monopoly at an unwarranted discount.
Makes sense.
It is a company that has successfully transitioned from buying growth at any cost to managing growth for maximum sustainable profit. And that is exactly the transition every mature investor wants to see in a tech portfolio.
I think that is a brilliant, comprehensive breakdown. But as we wrap up this deep dive, we promised you one final, fascinating nugget. And this is something hidden at the very tail end of the earnings call, completely separate from the software portals, the AI abstraction, and all the legal battles.
Yes.
The real estate.
It perfectly encapsulates just how deeply strategic CoStar's financial planning actually goes.
Right. This is a beautiful closing thought because it really bridges their total dominance in digital real estate with physical, tangible reality.
So CoStar just finished building their new massive corporate headquarters campus in Richmond, Virginia. Now, typically, when a corporation decides to build a new headquarters, it is a disaster for investors.
Oh, an absolute nightmare, usually.
They are notorious for going wildly over budget, taking years longer than expected, and basically becoming these massive debt-laden vanity projects for the CEO. But this project was the exact opposite. Management noted that this state-of-the-art campus is a marvel. It features a 21-story office tower, generative AI art integrated seamlessly into the glass architecture.
Which sounds cool.
It is tracking for LEDindy Platinum environmental certification, and it's capable of housing up to 4,000 employees.
But the architecture isn't even the impressive part, it's the financing.
Exactly. This massive, complex project was delivered completely on schedule, entirely under budget, and crucially, it was fully paid for in cash.
They have zero debt on a world-class trophy asset. And here is why this obscure real estate fact matters to your stock portfolio. CEO Andy Florence explicitly mentioned on the call that by owning this asset outright, free and clear, they have positioned themselves perfectly for a future sale-leaseback transaction.
Which is one of the most brilliant corporate financial maneuvers available to a cash-rich company.
Explain the mechanics of a sale-leaseback. How does that actually work, and why does it generate value?
Imagine you own a $500 million building, completely debt-free. It's an asset, but the money is trapped inside the concrete.
It's illiquid.
Right. In a sale-leaseback, you sell that building to a massive institutional real estate investor like a Blackstone or a sovereign wealth fund for $500 million in cold, hard cash.
Okay.
But at the exact same second the sale goes through, you sign a 20-year lease agreement with the new owner to remain the sole tenant of the building.
So you get $500 million wired to your bank account, but your employees don't even have to move their desks. The operational disruption is literal zero.
Exactly. You just start paying rent. Management noted that if they pull this lever in the future, it could instantly unlock hundreds and hundreds of millions in liquid capital.
Wow.
And they have a proven track record of executing this perfectly. They pulled this exact same playbook with their former Washington, D.C. headquarters and achieved a 145% value gain in just a single year.
It proves that they aren't just dominating the theoretical world of digital real estate data. They are highly sophisticated operators in the physical real estate market as well. They are essentially sitting on a physical gold mine that acts as a massive, entirely liquid contingency fund. If a competitor emerges, they have the cash to buy them. If the stock drops, they have the cash to buy it back.
It all comes back to that initial paradox we started with.
Exactly.
Yeah.
If you just glance at the surface of this earnings report, If you just let the algorithms read the headlines for you, you see a 26% drop in bookings and a downward revision in revenue.
You'd think the sky is falling.
You might think the foundation is cracking. But when you look closer, when you actually examine the mechanics of the 20% margins, the AI labor savings replacing compute costs, the aggressive share repurchases, and the debt-free physical assets acting as a shadow treasury, you realize the foundation isn't cracking at all. They're just pouring deeper, stronger concrete.
Well said.
Thank you for joining us on this deep dive into the numbers. Keep reading between the lines, keep questioning the mechanics behind your portfolios, and we will catch you on the next one.